Okay, for this class, we're going to start out with maybe a little review of last week. Then we're going to get into using both sides of our brain, as we talked about last week. There's going to be a lot of left side, some analytical work. There's going to be some right side, creative work. Some of the things we're going to look at are going to require both, but we're going to mix it up a little bit in this class today. Screen. Did everybody see that?
Yes.
Okay. Now, I hope you all were able to read that first chapter in the FinTech book and sort of get an overview, a flair for what it means to be a FinTech and what impact that has on the banking world and really what impact that has on other banks. There is a large bank in the United States called JP Morgan. You've probably heard of it. They've done very well over the years. They have good management and they've been doing well for the past, say, 13 years since the last real meltdown we had in the stock market. But Jamie Dimon gave a review, a speech the other day where he talked about FinTech. And to me, it sounded like he was running scared.
Work your style without overworking your hair. For salon quality hair at home, TRESemmé Keratin Repair with Bondflex technology builds new hair bonds with every wash. Get 20 times stronger hair with new TRESemmé Keratin Repair.
Lots to digest from Jamie Dimon. It first tells me this puts Plaid. They
we can't see the video.
In that, essentially the plumbing that connects your bank account to a FinTech app. Plaid works with thousands of those apps, including Venmo and Robinhood, which of course took off during the pandemic.
Yes.
As well as
We can't see the video. We only still see your PowerPoint slide.
Somebody say something?
Yeah, we can't see the YouTube video that you're trying to share with us. We can only see the PowerPoint slide. That was you.
I know what happened. I did this again last week. Hang on.
Okay.
I'll share. And then I'm going to share it again.
Users. Plaid says that it's.
Is it working now?
Can you up the volume a little bit?
Okay, but can you see it?
We can.
Yes, now we can.
A 60% uptick in customers last year. It also works with Google and Microsoft. And it has agreements with most of the major banks, including JP Morgan. In the bank's January earnings call, Jamie Dimon used Plaid as an example of, quote, unfair competition and companies who he says improperly use data that's been given to them. Plaid in response says that the company is focused on, quote, ensuring people have access to their own financial information so they can securely share it with permission in order to use some of those fintech apps that they choose. And they say that they have a data exchange agreement with JP Morgan Chase, among many other banks. Deirdre, back to you.
Yeah, and Kate, it's not just Plaid, right? Receiving that monster valuation. You saw Stripe get that $95 billion valuation a few weeks ago. And of course, we're looking ahead to Coinbase next week, which some say could approach, 100 billion at the highest end. Regulation, though, this is something that Dimon has talked about often, and something that we've also heard some from Jay Powell and Janet Yellen. I talked about this when we saw what was going on in China with Ant Financial and Jack Ma. Ant Group had this huge north of $30 billion valuation. It was taken down.
By the way, this was on TV yesterday.
Substantially after all of the scrutiny and rule changes there. How big of a threat do you think that actually is here in America? Obviously, very different systems, but you talked about privacy, obviously a big focus. We started the show talking about it. Do regulators sort of perk up and say, hold on, we need to change this? How hard could that hit the fintech industry, which has really just grown sort of unbridled over the last few years?
That could really slam the fintech industry. If you think of where Plaid sits in that ecosystem, they're really the plumbing behind that. So they connect these popular consumer apps, you think of Robinhood, Venmo, things that people have really taken up during the pandemic to your bank account. If that middleman weren't there and that didn't exist, consumers wouldn't be able to use that. So the argument here is that yes, regulation could come down on all of these fintech apps, but at the same time, the consumer demand is big enough. If you think about Coinbase, 56 million users, Robinhood added millions of users this year. So regulators might also have to be careful of the consumer demand here. You mentioned China. If you think about what happens in Europe, they have something called open banking, meaning that all of the banks basically have to put out APIs that make it easier to connect a fintech to a bank account. So if we go in that direction, someone like Plaid could really be threatened here.
That's interesting, Kate. I wonder, in Diamond's letter, he talks about fintech. He talks about big tech. He mentions Amazon, Apple, Facebook, Google. He mentions Walmart as well. He says their strengths are extraordinary, and at a minimum, they will all embed payment systems within their ecosystems and create a marketplace of bank products and services. I wonder when fintech hears that from a guy like Diamond, do they think we got them where we want them, or is their size and scale still a huge threat?
It's interesting when you mention big tech. A lot of those companies, you think of Google, has launched sort of a pseudo bank account and a debit card, but they use that to keep customers engaged. And Deirdre mentioned Ant Financial. They don't necessarily want to become banks. They want a reason for their customers not to have to leave the app. So they're not going to look for a bank charter, for example, but they may toe the line as long as there is sort of this gray area for tech. They will offer financial products. And if your option, especially younger consumers, is between a Google bank account and maybe one of the institutional Wall Street banks that they don't have as much of an affinity for, it is a real issue for some of the more traditional banks.
Shepard Smith here.
Okay. There was a lot in there. I think most of you have probably read the article on Ant Financial in Banking 4.0. The Ant Financial deal is still in the news. Ant Financial, as probably most of you know now, is the big financial services company that was founded by Jack Ma. And he's also the founder and CEO of Alibaba, which is like a Google for Asia, or an Amazon for Asia. It's a lot of things. One of the things it is a financial services company, but they wanted to spin it off. Now they wanted to have an IPO. You could be investors, but at the 11th hour, right before they were ready to do the IPO, the Chinese government cracked down on them, and they needed to stop the IPO all of a sudden. And it was a little fuzzy, the reasons why the country shut down the IPO. But basically, all you really need to know is that the Chinese government views Jack Ma, Alibaba, and Ant Financial as a huge threat. They have a big, old, lumbering infrastructure, and they're just not as nimble and dynamic as these fintech companies. So I thought that was kind of interesting, and that's why I showed it to you, because it's still happening today, that you have these fintech companies that are bumping up against the old traditional banks and the old traditional financial services companies and the old traditional governments. But as you can hear, Jamie Dimon, CEO of America's largest bank, is complaining about them. He's being defensive. He's running scared. And I'm pretty amused about that. Okay. One of the topics that we talked about last week was whether, and we're back to the right brain again, whether a commodity, a product, whether you should be selling the ultimate end use, like if somebody needs a hole in the wall, you get on TV and you sell people the advantages of a whole? Or B, do you go on TV and sell them the advantages of your drill, the great super state-of-the-art drill you have to drill the hole? And the answer is that you focus on the customer need. The customer needs a hole. The customer doesn't really need to be bogged down in the mechanical engineering of their drill, right? That's what you used to see in the old days when there would be an ad for a refrigerator in the 1960s. They would be talking about all the new technology in the refrigerator. And although it was kind of cool, especially in those days when a lot of new hardware was being developed, it's just sort of irrelevant to the end user. And it's something that you should think about as we go through these banking products. There's a lot of functionality and there's a lot of bells and whistles. They're very complicated. Keep that sort of in the left side of your brain, but in the right side of your brain, always think about what the customer is looking for and what they need. And there are really two types of products. There's a product like an iPhone. You want that product. That's a product that you just buy, okay? Then there's products that are sold. That might be like an insurance policy for something you have. Somebody has to talk you into that. That's a kind of product that is sold. The salesman has to talk you into it before you'll buy it. A product that is bought is something that people like. You have to stand in line to get it. It's the difference between pull marketing and push marketing. With the pull marketing, you have this great iPhone that meets the needs of a bunch of customers for a whole bunch of different functionality. And so people want it, you pull. Another product, you might be working on a new type of insurance for customers. That's more likely to be a push product. It's not the kind of thing they're going to come to you and ask for most of the time. So we talked a little bit about this last week. Changing consumer trends, new marketing channels, emerging technologies. They're all opportunities for fintech and regular banks to roll out new products. And it's not just to directly generate more revenue, although that's important. A new product can sort of flesh out your portfolio of products. And if you can offer something new, that puts you at a competitive advantage against everybody else because you have a superior suite of products. And people like to go to a one-stop financial services bank where they can get everything that they need. So in addition to your product creating direct revenue and profitability, it's also giving a little lift to the other products that the bank sells. We're going to be talking about retail consumer banks. Okay, it's the banking services that are offered to people like us. Checking and savings accounts, mortgages, credit cards, auto loans, lines of credit, brokerage services. These are products that would be beneficial to us as consumers. Retail banks, and we won't be talking about these, are not commercial banks that focus on companies and their banking needs. And we're not going to be talking about investment banks that focus on corporations and large governments. Our focus here is going to be on consumer banking. And the products that we talk about will be consumer banking products. And the product that you will ultimately come up with that satisfies some need will be a consumer banking product. Now, maybe I should blow that. It should be a consumer financial services product. Don't necessarily limit yourself to traditional banking. And here's a little bit of banking humor. This is back in the days when people would still do a lot of golf, play a lot of golf. Just in general, the way a bank makes money is they take the money from depositors and pay them a low interest rate and take that cash and use it to make loans to customers at a high interest rate. So they get the high interest rate from the customers, they subtract out the low cost of funds that they give to the depositors, and that's the spread. So what this is talking about here is the 363 rule. It's slang that refers to an unofficial rule in the banking industry that alludes to the condition of being non-competitive and simplistic. This was back in the old days when being a banker could be one of the easiest, cushiest jobs you can get. The 363 rule describes how bankers would give 3% interest on depositors' accounts, lend the depositors money at 6% interest, and then be playing golf at 3 p.m. So that's how easy it used to be. One of the problems is that we're paying our depositors a lot less than 3% now. It kind of changes the dynamics here. And we're not charging as much now. It sort of changes the dynamics, but that's the thing that you should be keeping in your mind when we're looking at banking products, is that bankers take cash, they give it to customers in the form of loans. Where do the bankers get the cash? They get the cash from you, okay? They get the cash when you are making a deposit. You're basically loaning money to the bank, and the bank pays you interest on the money that you are loaning to the bank. And they collect interest from, say, the mortgage customer, and then they have to pay you back your deposit amount, your interest, because you are a creditor to the bank. Don't think of yourself as just a bank depositor. You're very important to the bank. You're the ones that provide them with their cash to go out and make loans. Make sure they treat you with respect. Now, in addition to just the type of profits we've been talking about, the difference between what bankers charge customers and what they pay depositors, there's also many other sources of revenue that banks have. They have, account fees. They have ATM fees, generally for customers coming in from another bank. They have penalty charges. If somebody is 30 days late on their mortgage payment, they get a penalty charge. Banks also rake in lots of money on commissions. They sell insurance companies products out of a bank branch, and they get a commission for it. They're not getting the premiums from the customer. They're not paying the claims. Some other insurance company is doing that because the bank used their branches and their customers for the insurance company to sell their insurance to. Then the bank picks up a commission fee. And then there's all sorts of application fees. So these aren't the kind of fees that you really focus on. It's certainly not the kind of thing that they talk about in ads. But shockingly, these little fees add up to a huge amount of a company's profits. Look at penalty charges. When you're 30 days late, the bank gets a little nervous, but really they're jumping up and down for joy, as long as you don't go 60 days late. If you're the kind of person that just sort of hovers around 30 days late, you're going to incur some penalty charges, and you're probably not going to pay off the loan too fast because it looks like you're having a few cash flow problems. The bank doesn't want you to pay off the loan right away. The bank wants you to have it out there, and the bank wants to keep earning interest off of your loan. So if you're the kind of customer who can really never pay back the loan, but never gets more than 30 days past due, so you're paying your interest at some point just a little bit behind, and you're getting these penalty charges, you're a golden customer. What follows is a list of banking products. When we go through them, let's talk about the customer need that's being satisfied. So we're going over the right side of our brain. But in general, we've talked about this, is that you're going to charge your customer for your vision. Is it going to be an ongoing membership that you charge them $5 a month, say? Or is it going to be a one-time fee? And we'll do profit models and you decide which is the best for your product. You got to think, if you're going to offer a new loan to customers, you think about what the average size of the loan is. Now, you have student loans, as you know, that have big balances. You also have car loans that have $10,000 balances on. What are your expected delinquencies to be? And that means, who are the people? How often will people get behind on their payments? And is there an opportunity for additional monthly and annual membership fees? These 3 points up here, let's not talk about the expenses below that, are all going to be interrelated. You have an idea for a product, okay? You're going to charge an ongoing fee, say, and it's a fee based on the loan size. So that's something that you need to be cognizant of. Usually, the higher the loan size, the better. On the other hand, if you have high loan sizes, people are going to tend to want to pay that down. So it can be sort of a double-edged sword. You may change one variable and it has an impact on another variable. If you're to go back up to the first bullet and increase your fees from the customer by charging them a higher annual interest rate, you would think at first blush, that was a great thing to do. We're getting all this money. But go to the second bullet. If you're charging a high interest rate, a lot of people are going to compensate for that by buying or getting a smaller loan size, a lower balance on their loan, because they won't be able to pay the interest charges on a higher balance. So then you sort of defeated the purpose, didn't you, when you created this new loan? You charged more, but now you have fewer customers with lower loan balances. And this is what we've kind of been talking about, and you can just see it here. This looks like a mortgage to me. The average loan size is $250,000. We're going to charge the borrower 12%. We have an interest that we're paying the depositors. Now, this says 5%. These days, with interest rates so low, as you people know, you're probably getting less than 1% on your deposits. But let's just assume that we are charging 12% to the customer and 5% we're giving back to the deposits. Then that works out to $30,000 in revenue, just the loan balance times the interest rate. And then there's an income expense that is the 5% times the $250,000. The interest revenue the bank uses to make a profit. The interest expense is what the bank pays the depositors who give the bank their funds. The depositors are the ones who make this bank work. They're the source of the funds for the bank, and they're by far the cheapest source of funds for the bank. Now remember, I have this in here just to remind you as we're going to go through some products. We want to sell the whole. We don't want to sell the drill. Talk about the customer need. Then as we go through these products and look at some of the ads, think to yourself, is the product push marketing or is it pull marketing? Pull marketing is better. And then what does the profitability look like from the bank's perspective? So why don't we start out with just a checking account? And I know that I should be able to do quick links now. I can easily do them in Word and I can do them in Excel, but I just can't do it in PowerPoint. I don't know how to do it. I hit my limit.
Professor, probably if you click the key control and then click the link, that would probably take you to the link to,
Okay, let me do
to
it
the
on
browser.
So why don't you speak up again when I do the next one? You can guide me through it, okay?
No problem. Yep, will do.
Now, do you
In
see
the
this
fourth
one? or do I
quarter
have to
of this
stop share
year,
again?
we plan to go public.
I probably have to stop share. And I gotta start share again.
At the New York Stock Exchange. Today, you may still have a chance to invest in our company at a pre-IPO valuation. With a rewards checking account from ABNB, it's easy to do more of whatever makes you happy. That's because we give you 2% cash rewards just for using your ABNB debit card, having an automated deposit, and using e-services with e-statements. There's no monthly fee, no minimum balance, and no tricks. Enjoy more of life's rewards with a checking account that pays you, only from ABNB. Open, honest, hard.
Now, what are they doing there? Are they selling the drill or are they selling the hole? Raise your hand if you think they're selling the drill. Raise your hand if you think they're selling the hole. I see a lot of hands coming up. You know, if anything, they're selling the whole, but mainly they're just selling images of young people having fun at a beach. And somehow getting this checking account with a debit card is going to put you on that beach with a couple of vodkas, double fisting it. That's the kind of advertising they have there. Now, how does that look from your perspective as a customer? If you had like your own cash flow statement, well, you deposit the money into an account and somebody holds it in a safe place for you and you access it when you need it. Okay, it's that simple. What does it look like from the bank's point of view? From the bank's point of view, the checking account is providing the bank with the cash they need to make loans to other customers. So checking accounts are a very important way to source the cash for the bank. And it also, again, it provides like a wide suite of products for the bank. They have loans, they also have checking accounts. Okay, let's move on to the next one. Let's see.
Wells Fargo Home Mortgage presents Lulu and Lobo.
I can't coexist with these babies much longer, Lobo. We need a bigger place.
I know. Move to a new place sooner with as low as a 3% down payment on a fixed rate mortgage.
And the babies need to be trained.
Especially as they grow.
They grow.
As low as a 3% down payment on a fixed rate mortgage.
So you need to share the screen for the
A home mortgage.
What's that?
need to share the screen for the video.
Yeah, I was cheating that time. I was hoping it would work without doing that.
Wells Fargo Home Mortgage presents Lulu and Lobo.
I can't coexist with these babies much longer, Lobo. We need a bigger place.
I know. Move to a new place sooner with as low as a 3% down payment on a fixed rate mortgage.
And the babies need to be trained.
Especially as they grow.
They grow.
As low as a 3% down payment on a fixed rate mortgage. Apply online or talk to a home mortgage consultant today.
That's a pathetic commercial. It's very right side of the brain, but I'm not sure what they're doing for me. I've got a warm, fuzzy feeling about some puppies, but if I'm looking to buy a house and get a mortgage, it's not providing me with the kind of information that would have me go to that bank. But That's what advertising is about. It's about selling that whole. But again, that wasn't selling the whole. What they should show is somebody getting the keys to a new house, right? Something like that. I'm not their creative director. I don't know why they did it the way they did. Let's see, here we go next. And obviously the P&L on that one is the bank gets the money from the customers and their deposits, and it uses it to make the mortgage. And the P&L for the bank is they get all the revenue from the mortgage, and again, just pay a cost of funds to you depositors. Sometimes you'll hear me refer to it as a cost of funds. The bank needs your funds in order to make loans. Credit cards, I'm not going to show you an example of credit card advertising. You're all very familiar with it, but what I will say is that credit cards do a decent job of talking about their reward points and cash back. And that is something that the customer wants to know about. And it sort of does fulfill a need. So I think credit card ads are actually doing a little better than other ads. Then you have debit cards, sort of the same as the checking account. Here's an auto loan ad.
Is your current car payment too high? Auto Loan USA can help. We can lower your interest rate and payment. Put the power of Auto Loan USA to work for you.
I can't believe how low my monthly payments are, and I'm very happy with getting the car I got at such a great price. Auto Loan USA really helped out me and my family.
Online at autoloanusa.com or call.
If you need a car, just pick up the phone. 1-800-AUTO-LOAN. 1-800-AUTO-LOAN.
Effective commercial or bad commercial? You know, I actually thought it was pretty good. You know, it really talks a lot about what you get out of the product, what you need it for.
I thought it fits its purpose.
It what? Say
I
that
thought that, I mean, it shows what you're gonna get if you choose to get your auto loan, and what you're gonna feel when you get it, when you're able to get your car. I think it's pretty good.
Yeah, I thought so too. It's one of those good touchy-feely ads that make me feel like I want to do business with this company. Here's one that's probably very near and dear to your hearts.
If you've got student debt, hi, welcome. Our generation has 3 times the student debt our parents did. It's just not right. But you can get your student loans right by refinancing your student loans with SoFi. You can get your interest rate right by locking in a fixed low rate today. And you can get your money right with SoFi. Save thousands, fast, easy, and all online.
Yes? No? Raise your hand if you think yes, it was a good ad. Or liked it. I thought it was pretty good too. A lot of you are saying it was good. I thought it was pretty good too. It's a topic that really nobody wants to talk about. Now the question would be, if you wanted to categorize that commercial as a push marketing campaign or a pull marketing campaign, what do you think it might be? Let's go back to Madhura tonight. I see your picture, but I don't see you.
I think it would be a push marketing campaign because we are not creating a need. The loan is already there in the picture. We are just asking them to refinance.
Anybody else have any thoughts?
Actually, I think the opposite, because it's such a topic that everyone's talking about it. I feel like they're like, oh, we have a product that you need, but you're just asking for, solve your student finance. Here we are. And it's less than, we're not like trying to force it. You're like, yeah, if you want to refinance, save money, go for us, like it's less, it's more, it's a sell, it may seem like a push, but we're like, I think they're pulling you in some ways.
Yeah, I think so too. People have student loans. It's a tremendous debt burden. It's crazy. So people look at all the checks they're writing every month and they want out. This is something that they're looking for, some kind of relief. So the answer sort of falls in between, but there's a little bit of push and a little bit of pull on that spot. And I think it would be very effective. And by the way, it's too good to be in one of our traditional banks, from one of our traditional banks. It's from SoFi. You can see that I have a bias against the big, lumbering, stodgy, old American banks.
Also, the founder of SoFi, he tends to be very in the political scene, not only the financial scene. He tends to be an influential persona in the recent Twitter politics. I'll call it like that.
That's right. These guys are becoming Twitter stars. I can skip some of these. You can go through them on your own. Okay.
At Bank of America, no matter how you like to bank.
This way,
This way.
this way, even this way. We got you covered.
We've got thousands of ATMs.
They're super convenient. No deposit slips, no envelopes. How easy is that?
We have banking apps for iPhones.
And of course, iPads.
I love this app.
Access your money anytime, anywhere.
It couldn't be easier. Oh yeah, we've got you covered.
Secure access to your money anytime, anywhere with Bank of America. Download the app today.
See you soon.
Did I share that one? Did I do that right? Did you see it?
Yes, you shared it.
Okay. Good commercial? Yes or no? Thumbs up for a good commercial? Got some thumbs up.
I think it was okay.
Same as a thumb up. Now, for you people that don't like it, Michael, Why don't you like it? Where'd you go, Michael Rubin? There you are. Unmute yourself. Why didn't you like it?
To be honest, my internet's going in and out right now, and my dog was barking. I couldn't hear the audio.
I appreciate your honesty. Sorry about that.
It's all right. I'm gonna try and get back online.
Oh, that's okay. So find somebody else who didn't like it.
I personally abhorred it.
Yeah.
It made me rethink, why the hell do I have a Bank of America account?
Leonardo, you awake?
Yeah, but I've raised my hand before, so I like the spot.
I see. Okay. You're still checking in from Italy, right?
Yeah.
Great. Are you locked down?
Yeah, it's a sort of lockdown right now in our cities, so we are in our houses.
Do you have the vaccine?
No.
Wow.
We are still in over 75th for the ages.
You know, we have a lot of vaccine in this country that people don't want to use. Maybe we should just send it to you.
Yeah, I wish.
It really bothers me. Now, you should be thinking about maybe there's something you could do for a new product concept that adds a new twist to an ATM. You have to think about that, maybe interview some of your friends. But what would you like to see on an ATM or an ATM do that you can't currently do?
But then are we using so much cash? Do we need to go to ATM that frequently?
Do we need to go to ATMs? What?
Do we need to go to the ATMs frequently these days? We don't, right?
No, I don't. You know, I end up going.
As in, even if we innovate very good products on ATM platform, what use would they be, right? If nobody's going to use them.
Right. Let me get this to share here.
What about selling prepaid cards?
Prepaid cards are great. If that's what you want to focus on. I love prepaid cards. There's no credit loss.
I realize that $100,000 is not exactly a fortune.
103.
103. Okay.
Well, let me ask you guys, how long did it take you two to save that? Oh, a long time.
Long time.
Then it's a fortune. Well, I'm sure you talk to people all the time who think $100,000 is just pocket change. Right now, we're just talking to you. I told you we had a fortune.
Yes, you did. Getting closer to your investment goals starts with a conversation. Schedule a complimentary goal planning session today.
Okay. So brokerage services, and advisory services. Now, I thought that was a pretty decent spot. One of the things you might consider if you're doing a twist on a brokerage service is that I think you would find, or you may have found already, that when you go in and find a financial planner in a branch, they're not always that knowledgeable. And they seem like salespeople. And although the guy in the commercial that I see over and over seems affable, he's basically just trying to sell you something. So, you know, sort of a nice twist on advisory services would be that well, I don't know, you would come up with the twist, something that is a little more interactive with the customer so that a better financial plan can be produced. You know, maybe there's a way that the bank can look at your prior purchasing history and help you, because they've got the data on that, and help you decide what kind of brokerage services you would need based on that. I don't know, but brokerage services are a big part of consumer banking, and they're becoming a bigger part of consumer banking.
Convenient way to bank, right here.
And it's better than ever.
With Bank of America mobile banking, you can securely deposit checks you get right away with your smartphone camera. Watch this.
And now with Bank of America, you can securely send money from your smartphone or tablet.
You only need the person's mobile phone number or email address. No more text and no more IOUs.
Check balances, pay bills, transfer money, and more. You can bank on your schedule.
Right here.
Download the Bank of America mobile banking app today.
Now, that one I felt it was a little bit heavy on the talking about the product side as opposed to what you might need the product for. But it's just a minor criticism. I'm getting a little picky. Let me skip some. This is a product, a program that you might be interested in. Again, you could do a twist on this.
In the next 2 minutes, I'm going to show you how advertisers can maintain ROAS while scaling ad spend. Now, here's the thing.
To my mind, retirement is all about having more time to spend with the ones you love and more time to enjoy what you've earned. But unfortunately, many older Americans just don't have the money to do all that. Most people thought the three legs of retirement, pension, Social Security, and savings, would be enough to get by, but it's kind of like this three-legged stool I'm sitting on. A little wobbly, but I think I might have a solution. What many people don't realize is your biggest asset might very well be your home. And using your home's equity with a reverse mortgage loan from AAG could play a vital part in funding your retirement. Not to mention, give you the cash to cover all those bills that seem to come out of nowhere. Your home's equity could add a fourth leg to your retirement plan. Much better, not a three-legged stool, but a home equity chair. 4 legs, more stable.
Call us today to receive a free information pack with no obligation that contains a helpful 3-part guide to reverse mortgage loans and DBT. Learn about how they work and about many consumer safeguards that are in place to protect you and your home. Our important new reverse mortgage retirement planner explains the many flexible ways a reverse mortgage may provide stability for your retirement. We even provide a guide filled with information for family and loved ones to answer all their questions. It's got what you and your family need to know about reverse mortgages.
Retirement's a time to enjoy life. After all, 70's the new 50, right? Using your home's equity as the fourth leg of your retirement plan just may give you the stability you're looking for.
Call 1-800-817-0479 for your free information packet.
AAG, bringing stability to your retirement.
Professor,
Yeah. Yes.
was this an advertisement as well?
Say that again?
Can you hear me?
Yeah, I can hear you.
No, I was asking if this was an advertisement as well, because it seemed kind of really long, lengthy.
I'm not sure I'm picking up your question. Can you ask me that again? I'm having a hard time hearing you.
I was commenting on whether or not this was an advertisement because it was long, like a mini documentary. It was good, but it was like really long.
Yeah,
like I feel like people will stop paying attention.
It's a commercial. What happens for those longer commercials is they're generally on some obscure TV station at some obscure time of the night, late time of the night, these long commercials because it's cheaper to buy advertising time then at a time that nobody's looking at the TV. So they tend to have long commercials. It's 7 o'clock now. Why don't we take a 5-minute break and then we'll resume, okay? Back at 7:05. Okay. Let's reconvene. The reversed mortgage, it is complicated. That ad really is a hybrid of push and pull. The product serves a very important need. Seniors run out of cash in their retirement, but they own a home and they have equity in their home. So they'd like to tap into that. So a lot of them have an aversion to getting home equity loans. Instead, there's a reverse mortgage model where basically you sign over the house's collateral, and the mortgage company, the reverse mortgage company, sends you, the homeowner, a check every month. And that's what they use to live on. When they pass away, the house is sold. The interest owed to the reverse mortgage lender is paid. And the rest of the balance goes to the heir, who's ever going to inherit it. I think it's a pretty good product. It certainly fulfills a very important basic need, but it's complicated. It's complicated to explain, to understand. And I think that has been part of the drawback on that product. So maybe somebody could work on a reverse mortgage that is at least marketed a little better and maybe has a subtle change from the reverse mortgages that you see out there. I think that since reverse mortgages are sort of in the infancy, even though they've been around for a while, I think there's a lot of work that could be done on coming up with a better reverse mortgage. Now, this is something that's often, well, something that's also not too often offered by banks, specifically credit card products. Okay, hang on, I missed that one. And this is one of my favorites. Okay.
That time of year again. Time for City Price Rewind. Because your daughter really wants that pink castle thing. And you really don't want to pay more than you have to. Only City Price Rewind automatically searches for the lowest price. And if it finds one, you get refunded the difference. Just use your City card and register your purchase online.
Have a super sparkly day.
Okay. Now all you need is a magic carriage. City Price Rewind. Buy now, save later.
That was my product. We sat there for half a day, as that woman was saying, have a super sparkly day to get it just right. The idea was to differentiate our credit cards at Citibank from other credit cards, whatever other bank, Bank of America. The way they did it, we did it, I should say. The way we did it was we offered a service where after a customer made a purchase on the Citi card, we would give them a refund if we at Citibank found the same item for less money. So a customer could go out with peace of mind, not even doing a lot of comparison shopping, know that if they use the Citi card, there's a program where if we, the bank, Citibank, finds it cheaper somewhere else, we'll refund the difference to the customer. Now, how do we make any money off of doing that? There's no direct money that's made off that. It's indirect. The idea would be that I'm going to use my Citi card and not my B of A card, because with the Citi card, I have price protection. And if I pay too much for an item, they're going to refund the difference. So that was out there. The ads were a big success. The ad was actually played on the Jimmy Kimmel show because they thought it was crazy. They had never heard of something like that before, and they thought that we were going to lose our shirts. But it didn't really work out that way. The claims costs were manageable. Claims costs being giving people refunds. That expense was manageable. And it drove a lot of customers to use the Citi card to get that additional benefit. Now, if you come up with a program like that for your project, I mean, that would be beautiful. It's not your traditional loan. It's not a checking account. It's something that's you've heard the expression bells and whistles. It's a bell or a whistle that you're adding to a traditional credit card product that puts it head and shoulders above all the other credit card products. And although it's attached to a loan, it's really its own P&L. So spent a little time on that one because it's near and dear to my heart.
So, Professor, were you responsible for the promotion as well for the product?
Yes. Yes. We had the idea. We had the idea for the product. And then we took it to the marketing people to see if they thought that it would indeed help them bring in more business. And then after that, we did a very, very, very heavy duty financial analysis on it. That would be what you people would be bringing to the table. Okay. Now, what did we really have to worry about with this product? The worry, the risk was that we were going to have to pay so much in refund costs that we'd go out of business. So we looked at a lot of data that the credit card business had with offering free programs before. And we looked at that data to see who was it that took advantage of those free programs? Who signed up for them? What did it do for them? How much did it cost us to offer that free benefit? So we did the same thing with this product, and we came up with a fairly low estimate for what we thought the refund costs were going to be. So we thought, this is great. We have this product that's going to bring in all these customers. The refund costs are going to be pretty low. Everybody wins. But then somebody at the bank came to me and said, we're just not comfortable taking on that risk. You're going to need to go to an insurance company and have them insure the risk on this product, so that if there are any offers that are due a refund, then it's the insurance company that pays the refund. We just pay premiums to the insurance company. So that way, the bank doesn't have the risk of too high refund payments. So I went around to a lot of different insurance companies to see if they would be interested. And you know, once they got it, they were interested. And they came back to me with expected claims cost, expected refunds of $300 million. And they wanted the premiums that would support $300 million. Now, before that guy made me go talk to the insurance companies, we thought the claims were going to be somewhere between $5 million and $10 million. Okay. But when the insurance company looked at it, they thought it was going to be $300 million. So we did it without the insurance company. And instead of the claims cost being $300 million, they weren't even $10 million. They were like $6 million. So for reasonably low claims costs, we drove all this business onto the card. Okay.
Professor, sorry for interrupting. Was that across the United States or just a regional offer that you did?
It was across the United States.
Wow.
All our cards across the United States. When I left, the claims cost, the refund cost started ticking up. And they looked at it again and they thought we weren't getting quite the lift on the credit card business that we would hope to get from this product. Now, the claims costs were going up, so that was a knock against the product. But the biggest knock was the regulators. They didn't understand we were doing it. We would explain to them and they'd still be kind of fuzzy. I would walk them through it, and you know, your regulators are often looking for a scam. And there was just no scam here. And when I left, they were still looking for a scam, but there was no scam. But then a few years later, they stopped the program because, like I say, it wasn't giving the card the lift that they hoped they would get out of the product. But something like that, somebody comes up like something like that for their product, that would be beautiful.
Professor, quick question. So the revenue that the bank was getting from that was just revolving balances and like transaction costs?
That's right.
That's it, right?
That's right. But, you know, we hope to get more revolving balances just by offering this program, and that the profitability off the higher balances would exceed the refund costs that we were paying.
Right, I see. Okay.
So free to the customer, regulators tried to explain to me how it could be risky for the customer. I never quite understood it. And so we just sort of parted ways. I left the product and it kept going for a couple of years, and then it died because of claims expenses. But, you know, I really thought it was good.
It sounded more risky to the regulator's ability to think than to the customer.
Yeah, exactly. Because they could look at our historical claims costs after a year or two, and it was obviously nothing for them to be worried about, at least at that time. So it was just, that was a time that the CFPB, the Consumer Financial Protection Bureau, was being very rough on banks.
I used a credit card to treat my... I used a credit card to treat myself to a little chunk of heaven, baby. That singles weekend in Tijuana, freaky deaky. But first, I needed to power up my babe magnet. Self-tanning cream, fresh hair plugs, and a complete wax job on the old chassis. Ouch. Slow down, ladies. There's enough Larry for everyone.
Fraud early warning. When we see suspicious spending, we'll alert you and stop it. City Identity Theft Solutions. That's using your card wisely.
Okay, that was another one. That was another one that was offered to customers to increase engagement and loyalty and feel like they should use the card, because if they lost their city had this program to cancel the card and cancel and have them resend a new card. And it wasn't just for city cards, it was for other cards as well. So it's a good product. It's a good way to make some revenue. There was a deluxe product that they charged $5 a month for. And the sort of the claims cost, the costs of providing the benefit to the customer were very low. So it was profitable in terms of each unit that we sold. And it was also profitable in that it brought additional business onto the Citi card. So again, it's another win-win. We've got other ads here for a youth savings account. Different programs from different lenders that you can take a look at. There's one here that I always wanted the bank to offer, and it was called tuition insurance. And it was at a time when the bank was able to sell more insurance programs than they are now. And I wanted that to be a program for our younger customers who were just starting out with families and had to face the prospect of paying tuition 18 years down the road. So it seemed like there could be an opportunity for an insurance company where parents would start paying premiums when the child was born, pay premiums over and over the years, and when they were 18, they would get the expenses from the insurance company to go to the college that they wanted to go to. And the way that it would be funded was that there would be a lot of people paying for their kids to go to college month after month, year after year. And then the kid would decide not to go to college, or the kid decided to live at home and go to a JC or something. And the insurance company didn't have that much that they had to spend for that student. But, you know, what's the most expensive college in the US? I think it used to be Sarah Lawrence, a girls' college up in Westchester. So, I mean, that's a way that you would fund Sarah Lawrence, is if you start as a when your child is young, you evaluate the child and say, this is a child that could end up going to Sarah Lawrence. It's going to cost me an arm and a leg. I'll start buying this insurance policy now with these low monthly payments that will ensure when my child is 18 that she'll be able to afford the college that she wants to go to. So I pushed that all over the place. I pushed it to insurance companies. Insurance companies liked the idea, but I could never get approval from the bank to offer it. But it's a financial services product. It's related. There's a lot of synergy between that and other financial services products. Unfortunately, this one never got traction.
Are you saying parents don't trust their kids to go to a good college?
Say what?
Are you saying that parents do not trust kids to go to a good college?
I think they were worried that the kids were going to go to Sarah Lawrence. I think they were worried. Okay. You read about fintech, and this is a slide that I found that I thought was pretty interesting. The investment banks have been starting out spending a lot more than the consumer banks, the American consumer banks. And I feel like the American consumer banks have their head in the sand to some degree. And I'm leaving you some ads here that you can look at offline for some inspiration about some of these programs that are out there. And you might find that in all the programs we talk about, and I've shown you, there's a gap. And there's a gap in what the customer needs, and that's an unmet need. So you could come up with something like that. And here's something that I found that features of the credit card that people found to be the most important when they were shopping. And 75% said no annual fees, lower interest rate 56%, no late fees, 0% introductory fees, blah, blah, blah. But you can take a look at this, and if you're coming up with a new credit card product, this might help you, give you some guidelines on what features the credit card customers think are important. when you're developing a new product, you have to ask yourself, is this a product that you would develop if it was your own money? Okay? And let's just say you're sitting in a consumer bank and you're dreaming up a new product. It needs to be relevant to your customers. If you're in a bank, you need to be offering consumer banking related products. It needs to be relevant. It needs to be something that people are going to want so that there's demand and there's customer penetration rates that will enable you to scale it. The first thing you need to do is make sure that your product has unit profitability, that what you take in revenue is more than your ongoing expense. Once you have something that's profitable like that, then you can go back, like we talked about next week, and decide how much you can afford to pay in marketing costs to bring on these customers, given the profitability that your product throws off. It may not throw off much profitability, and therefore you can't spend any money on advertising. Or your product may be very profitable, and you can spend a lot on advertising, and you'll be able to scale up rather quickly. We talked about scale, the complexity of the product. Don't make it so complex that people won't understand what you're offering them. And if you want a good example of that, go back to the reverse mortgage ad. Even though it was long and went into some pretty granular detail, it's still a mystery to a lot of people, or most people, the vast majority of people, how it works at the end of the commercial. So complexity is something that you have to be concerned about. The risk associated with your product, you may be offering another loan. You might be offering a loan that has lower credit standards. You're going to offer it to people with a lower FICO score, okay? You're going to get more people that way. You're going to increase your volume of marketable people because you're going after riskier people. But that's the downside. You're going after more people, but with the lower FICO scores, maybe you shouldn't have done it because it increased the risk of your product. Which, as we work through these models a little more, this kind of trade-off between the different drivers and variables is going to become very, very clear to you. Your left brain is going to do it automatically. I don't want the left brain to overshadow the right brain in this course, though. So that's why we're looking at some commercials today. You need to look at the uniqueness of your product. Don't offer something everybody else has. Or maybe you need to, just to be defensive. But it's better if you can go out there and get, first, what is that expression? First mover advantage. First mover advantage, the first people in with the product. Regulations, regulatory issues, whether they will like your product or whether they will have a lot of questions about your product, or whether the regulators could even sue you for your product, which can happen too. The regulators can sue the bank. In the next couple of lectures, I'll tell you about the product that I had that the bank got sued for. Also, you have to worry about cannibalism, or at least you need to be concerned about cannibalism. If you're offering a new loan, does that mean you're just going to be taking business from another loan that you already have? Are there upsell opportunities? If you come up with a new loan, can you charge them something like for that price protection, or should you offer the price protection? Can you upsell them with a product that will cancel all of your accounts if you lose your wallet? Anything that creates upsell and cross-sell opportunities. This is really a good comprehensive list for you to look at if you're thinking about a customer pain point that you want to address with a new product. Okay, I shaded this. A major downfall of new products initiatives is a lack of detailed financial analysis up front before the product is launched. It is a major problem. So we talked about this last week. We did a little bit about this, the beginnings of a model. And so I thought what I would do is, let's go through one of those with you. So we're going to do a little P&L. And we're going to do a product that we're just going to sell as a membership program. Say it's $5 a month. So we're going to say that the product price and we'll say, and we're going to say it's $5. Okay. Now, if anything is going to be an input to our model, we're going to make it blue. And anything that's not an input, anything that's not anything that's not an input, like a calculation, won't be in blue. So now we have the product price that we're going to get, and now we need to know what our ongoing expenses.
Oh, so we can't see your Excel sheet if you're on one.
Okay. Oh, great. Now I'm having problems. Problem is that I lost. Let me if I do this. Okay, just hold on for a second. So now you can see it, right?
Yes.
So we're going to say, what are the expenses of this $5 product? Well, I don't know. We're making this up, and you're going to end up making it up too. But for the purposes, it has to be something reasonable. For the purposes of this product, we're going to say it's 25% of whatever the revenue is, are your ongoing expenses. Okay. Okay, and then the next thing we need is an acquisition cost per customer. And we're going to say that that is $10. Okay, and again, it's, I lost my ribbon here, hang on. Well, if I was coloring it, I would color it in red. Okay, so this is the assumptions that we're going to use in our P&L. Okay, now we're going to create a P&L and we're going to make it a 5-year P&L. And following standard financial control format is that the periods always go across horizontally. And the line items for the P&L always go down vertically. Why is that? Because what you're really doing is you're comparing one period versus the other. And when you're creating some kind of financials, you really want to do that. You want to have the periods that, or the items that you're comparing going along this way. Okay, so we have our product price. Now we have to have people attriting. Oh, let's also start out with number of new customers. And we'll make that 100. Okay. Now, you're going to start out with 100 customers, but people are going to drop your product. Okay. So these are years going across here. So let's just say at the end, at your first year, you lose 60% of your customers. The year after that, you lose 40% of the 60% that you have left. Okay. And then you lose 30% the next year, and you lose 20% the year after that, and you lose 1% of what's left, or 10% of what's left after that. Okay. I lost my ribbon here.
Professor, on the home tab, right there, just click on home.
Thank
there
you.
You go. And if you want to keep it, just click, where's this thing? Maybe just right click on it. Okay. Anywhere on the ribbon.
Okay. Now I'm looking for how I can format it. So it's here underneath this. Well, I won't worry about formatting it. Okay. So at the end of our first year, we're going to have 100 customers times 60%. Oh, times 1 minus 60%. Because we're actually going to have, and this shouldn't be 4,000. So again, it's a formatting issue. And I can't get in there to format. Let me do this. Oh, here we go. That wasn't very smart of me. Okay, so this one is going to be blue because it's an assumption. Assumption. And these are all assumptions here. This is the attrition rate every year. Since it's an assumption, you'll make it up. So we start off with 100 people here, and we lose 60% of them the first year. And we lose 40% of what's left the second year. Okay, so now we'll come in with a little formula here. We'll say customers. And they're really the end of period customers. So we take this, we have our 100 that we start with, and we multiply it by what's left. So you have 40 left. Oh, okay. So this one, we have 40 left. And we're going to multiply it by 1 minus 40%. Okay, so we have 24 left. And I think I can copy that across now. Okay, we don't actually have 13.44 people, but you understand as mathematicians, we could have made this 1,000. We still have decimal places, but you understand what I mean. It's all a variable. What I'll do is I'll just format this so that there's no decimal points and we don't have to worry about it, okay? So there we have our customers. Why 60% the first year and a lower attrition rate the years after that? Because it's the first year that they look at their statement and they see this product that you're charging them. And so a lot of them cancel it. They say, well, this isn't adding that much value to me, so I'm going to cancel it. Okay. The next year, you have 40% of the people cancel it. It's a little better than the first year because they've had it for 2 years and some people see the value of it. In the third year, you're getting down to the people who just never look at their statements. So they're not attriting off, they're not lapsing off. And you get down to year 5, 10% are attriting every year because they've got their head in their sand and they forget that they're even buying the product for the most part. But you could change these. You know, we could say that 80% lapse the first year. So then we're down to only 60 people at the end of 5 years. So the number of customers you have is a main driver of this. So now we're going to have revenue. And then we're going to have expense. And then we'll have net income. Okay. So the revenue is going to be your product price, $5 per month, so that we're going to multiply it by 12. And then we're going to multiply that by the number of customers that you have. And that's the revenue that we get. I think I should have locked this one in. Okay, does that make sense to everybody? We would have 60 by 5 times 5. I think that's right. Let's do a sanity check.
Can you click into the cells of customers? You changed the formula that you were using?
For customers?
Yeah.
I just took the customers that we have from the prior period. We have, we have 200 from the prior period.
No, that's what happened. You changed the numbers. That's why.
Yeah, you can see it. And then the expense, we said was 25%. Okay. So we're going to take the revenue and we're going to multiply it by 25% every year. I forget how to anchor in these things. I used to have people that did this. Okay, so we're going to pull our expenses over here. No, so I didn't anchor it in right. What did I do wrong? Yeah, this is the one that I should have locked. Okay, so your net income. So what you have here is an enormously profitable product, right? Okay, now we could make that $1 a month and still be profitable. It's all variable. Let's see. Sometimes I like to look at these as if it's a one single customer and you have the fractional amount of that customer. But you can see from a single customer, you do a sum here, over 5 years, we're picking up how much revenue? 2, 3, 4, 5, 6. $6 of revenue that we're picking up. Okay. So that's going to be the basis of a lot of your modeling. Why don't we just leave it at that? But for the time being, you're going to have a product. You're going to think about what you want to charge the customers. You're going to take some expense for the product. You're going to sort of make a guess for what you think the expenses would be. If you have to make a guess, a good guess is always around 25%. Give them a 75% profit margin before you put in the acquisition costs. So what you need to decide is how much money you can spend on an advertising campaign for these 1,000 customers. Okay, and still be profitable. Now let's say that our objective, profitability objective, is an 18% IRR, PT, RR. An 18% internal rate of return. I'm not going to define what an internal rate of return is for you. You've all had finance, I think, and if you haven't, it's a simple concept. You can look it up in a book. But here we have all this profitability, and why don't we make total over here? Format that a little bit. Okay, now I don't need a total there. Okay, does this work? Does it box? I think so. Okay, so on a customer with this product, one customer, we're making $57. Based on, that's over 5 years, we're gonna make $57. And that's based on these attrition rates. Let's say that people love it and they never attrite. Well, look at that, how much you're making a customer. How much were we making before? I forget. But anyway, by cutting down the attrition rates, you're going to have a lot more revenue and the 25% expense that goes along with it. So let me put in a column here. Okay. What the hell is going on here? All right. Okay. So here's our net income. Question is, how much can we spend to acquire these customers? Okay, now I'm going to take a step back and try to make this new product analogous to a loan. No, make it analogous to a bond that you buy. You buy a bond for $1,000. That's your initial outflow. And then you expect the coupon payments to come back to you. Okay? And the idea is to make a reasonable return based on that $1,000 investment. It's no different for a product investment. You have a product out there that evidently gives you $97 of profit in the first year, up to $398 of profit. So now, how much can you spend and make a 18% IRR? Okay, so we'll make the IRR calculation there. And we're going to say, okay, well, if it's $10 a unit, the acquisition cost per customer, $10 times one new customer in this case, and we'll make that a negative. Okay, so now this looks a little bit more like an IRR formula that you're used to, right? It has its initial outflow with the -10, and then there's an inflow. And that's what creates your IRR, your initial outflow, and then your cash flows that come in, and we'll say through the first year, for the first 5 years. We can stop after that. Okay, I thought that this was a little bit too aggressive on our part, so let's go back to something like this. And okay, making $111. And here is our initial outflow. Just like that. Okay. Now, $10 per customer to acquire them is probably low. So we'll make it $100 per customer, and I'll show you how that works later. So then if we do our IRR using the Excel IRR formula, we get a 5% IRR. Not bad, but below our profitability objective of 18%. Got a little bigger. Let's really highlight this thing. Okay, this little model gave us a 5% IRR. Now we want to get to an 18% IRR. Can this product even do it for us? Okay, let's assume that this $100 per customer, this acquisition cost is good. We're stuck with that. How can we get this product up to an 18% IRR? How are we going to do that? Well, maybe we're going to charge them more. Maybe we're going to make it 20 bucks a month. No, make it 10 bucks a month. Okay. What was it before? Was it 5? I forget what it was before. What did we have this initially as? What was it?
12.
I still didn't catch that.
12.
Okay. Okay. So now, thank you very much. My memory is like a sieve. We've got ourselves a little model here that we created for this $12 a month product. Okay. Now, it doesn't meet our IRR objectives. So I'm going to raise this. Now I get 34%. That's great, right? we changed the price. We knocked it up from $12 to $20, and look what we have. We have a 34% IRR. Great, right? No, it was too simple. When you raise the price, your attrition rate should go up, right? You're only going to have 20% left at the end of the first year. So now you find yourself with a negative 3% IRR, right? It didn't work for you. So let's take this back to the 60%. Okay. And we know that it didn't work out for us because $20 a month was just too much for people and they were canceling the product. So how do we get that IRR up to 5%, up to 18%? Well, you might say, I was too conservative when I said it was 25% for the expenses. Maybe it was 15%. Not bad, we're getting a little closer. You just had to cut your costs down. Okay? And maybe, just maybe, we changed the acquisition cost per customer. And there's a little model down here that creates an acquisition cost per customer depending on these variables you put into it. Okay? And we have 100. We need something that's less than 100. So we're going to take this direct mail and we're going to increase the number of people that respond to this campaign. We're going to increase it even more. People are responding like crazy. So now we have a $68 cost per sale. And this is in the notes. You'll be able to see how this was created. So instead, I'm going to put in for the acquisition cost what this submodel threw off. Threw off $68. Okay? Boom. 34% IRR. Didn't do much for us.
Professor?
Yeah.
And that should also be even higher because then the attrition rates would change positively.
That's
right.
That's right. That's right. Exactly right. These are the moving pieces. It would almost be enough for the financials that you have to do for the class. I have a bigger and better model that I'm giving you that you'll see in the notes. But basically it comes down to this. You want to come up with a set of assumptions that'll get you a 12% IRR. Now, what if you say, hey, 34% is better than 12%. Why should I change anything? Okay. Well, you're going to change something because you could go to a larger number of potential customers and solicit them. And the more customers you go to, the response rate's will start to decline. So then your cost per customer will go up, but you'll have plenty of more customers. You'll see when you work this model. And I think, you know, either from the lecture tonight or going over the recording of the lecture, you'll see how I did it. It's pretty easy. You know, just do some sanity checks here. Let's see, we have 1,000 new customers. Okay, we have 400 at the end. Saying $12. Yep, 57,600. Boom, boom, boom. Okay, we have a model that works. Don't forget to do your sanity test. Okay, now that's the left side of your brain. It doesn't get much harder than that. Everybody take a big sigh of relief. You're going to come up with a product that you think meets an unmet customer need. Tell me what you're going to charge for it, what your expenses are, what your attrition rates are, and whether you think it, what you need to do to get to an 18% IRR. We could have changed this. We could have said, instead of a $12 per month product, we're going to make it a $100 one-shot product, right? So you have 100% of them here, and at the end you have none of them. It's a one-shot product. Okay, so we'll change this formula a little bit. You don't need this. Okay, and where do we get our customers? Why H266, right? Times L minus 1267. Why do we have 0 customers here? Oh, because it's the attrition rate. I need to make this 0. I had it going backwards. Okay, now this is a big mess. It makes a lot of money. You can turn this down to say $25, 160. All we know is, oh, wait a minute, we shouldn't be getting this revenue. So this is 100% for the second years. Because it was just one charge for the first year. So now you only have customers for that one time that they pay. Wasn't enough. Let's make it $50. Wasn't enough. We'll make it $100. Ha! At $100 a month, you're as profitable as you need be. And you might be able to go out to more customers and have even more profitability, but at a lower IRR. And I don't want to confuse you. Just try to strike for an 18% IRR. But if you're above it, that's better than being below it. Okay, and the difference in this model is that it's a one-time payment. Okay. All right, it's 8 o'clock. Let's cut out for another 5 minutes and then come back. Okay, it's 8:03. Let's come back at 8:08.
Professor?
John Stanton, back for another class. He was in my last course.
Professor, what do you think about NFT?
Yes, Professor, how are you this semester?
Okay. The next few pages in what I put on Blackboard is going to have a couple of examples of more complicated financials. When I say more complicated, I really don't know if that's the right word, because the model that I give you is just bigger. It has more functionality, okay? But it's the same concept. Revenues minus expenses. Are you profitable? And then if you are profitable, how much money can you spend acquiring customers? That's what it comes down to every time. Very rarely do I ever say anything as VIC, V-I-C. But this is a very important concept, and one that if you understand this now, tonight, it'll make your understanding of your class a lot easier. And it just talks about how we're basically making a marketing investment, which is the same as buying a bond, and then getting the cash flows off it and seeing if it's profitable even with your acquisition costs. That's the main thing. Okay. We did talk a little bit about Ant Financial. I didn't think we were going to until here, but I saw on CNBC yesterday, Jamie Dimon, so I slipped it in all right. Let me, taking a great risk here. Let me try to do this. After a lot of effort and buying this Shark Tank episode multiple times, I figured out one way around him that I could show you this. So please tell me you can see it now.
Next to the tank is a convenient way to get cash when you need it.
Professor, we can't see it. We only see the list.
Yeah.
It was hard to hear. Best I could do. So, interesting idea. It's a little hard to follow, but he, rather than having ATMs or branches alone to get cash, his idea is that you go up to the merchant and ask for the cash, and the merchant acts almost like a human ATM. The advantage, the clearest advantage, is instead of charging $4 a transaction or $4 something a transaction, they will charge $3 a transaction. You could see from some of the people asking questions that they just didn't understand what was going on at all. The one guy was talking about 3% versus 4.5%. What am I going to do for an extra 1.5%? Am I really going to walk? It wasn't even percent, it was dollars. And not that it's a big deal. It's just that when people throw these pitches out, there's a lot of details, and a lot of the details go right over somebody's head. So you go to one of these merchants that has the machine, and you get your cash that way. It seems like he had a lot of interest. He had a bank that was willing to give him $9 million. He valued his own company at $14 million, and we won't go into the valuation and how he did that because he went like this. He just made one up. And it's not too dissimilar to what you'll be doing. You have a product and you take your best shot at what you think it's going to look like with all those drivers of profitability. What you're going to charge people, how long they're going to stick around, what your expenses are, and lastly, can you afford any marketing costs to get them? But it needs to be your idea, not this ATM idea that was a little questionable in my mind. What was it called? It was called Spare? Spare, was that it? Spare?
We had, in India, we had
Yes.
such a product for some time.
You should just Google it and see if he's still around.
So he's still around, but honestly, amazing idea for 2010, not for today.
An amazing idea for what?
2010, not for today.
Interesting point.
I think really it's a genius idea, but I think you just missed the, like now everything is truly digital. Even you know, I even joke around, like there was a group of people who asked me for money, and I'm like, listen, I don't have any cash anymore. And they're like, don't worry, we also accept Venmo. So he has a great idea, but it's too late.
Anybody else?
I actually looked up this company on the App Store, and it was there.
There?
Yeah, it's on the App Store, and they have some pretty good reviews.
I'll download it.
Yeah.
I would think it's a good idea, like that, as Or said, in 2010, because you know sometimes even the chip of your debit card doesn't function very well. So that's a good idea. But nowadays we have the tap function, so we have the tap feature. So yeah, I would say it's a good idea for 2010. Yeah.
I mean, also a lot of banks offer you cash back at the end of the month for your ATM fees. Like I have a Schwab account, and at the end of every month I get $4 or $5 back for any ATM fees I incurred during the month.
Yeah, that's good. That's very good. So he's still got an app out there. Somebody was willing to give him $9 million as a loan. I don't know how much the place is really worth. But he's an entrepreneur. He had a cushy job at a bank, and he left it because he had this vision. He was willing to sleep on people's couches. Very impressive and very admirable. And he got a pretty good deal from Mark Cuban too. It's not.
But we had similar idea in similar products in India as in few years back. So I think it's not an innovative idea.
Oh, well, how did it work?
As in before demonetization, which happened in India, it was there, I think, for a smaller duration.
Okay. Well, that's what I wanted to leave you with tonight in our hybrid model. The rest of it is offline. We probably spent more time than I thought we would here tonight. But I think it's been a good session. You have an idea of how you need to work your left brain and your right brain to accomplish your assignment. And believe me, everybody gets it out. It's a little scary at first, but I've taught the class before. Everybody comes up with something. And this is, if you can't come up with something, you know, contact me. You can email me anytime you want, obviously. And I'll get back to you as quickly as I can. In some cases, it'll be a question that I think will probably be better handled over the phone. We might do that. But that's the way, if you want to reach me in this sort of hybrid model, just send me an email. And I don't mind them. If you want to bounce an idea off me, or if you're a little stuck on the P&L, it doesn't matter. It's not a requirement. Most people don't, but if you want to talk to me, that's fine. I'm willing to talk to you. I'll make the time.
So these assignments are individual assignments or team assignments? So will these be individual assignments or team assignments?
The usual assignments, say that again?
So will it be as in one person assignment or a team assignment?
One. It was going to be a team assignment last year, but then COVID happened. So that's how in a matter of 5 days, this whole course went offline and onto Blackboard. And one of the changes that I needed to make was that it wouldn't be possible really to do team presentations. So you'll do your own presentation. It should be on a deck, a PowerPoint deck. If you can't, sending me a Word document is okay. But you're going to try to sell me on your product. You're going to try to sell me that it fills a need that's not being addressed, that the financials work. We went down that checklist of things. Is it relevant? Is it scalable? All those kind of things. You need to answer those questions, or the ones that you think are important for your product. And then your deck needs to be a pitch deck. It needs to be similar to what this guy did with the Shark Tank judges. You're going to come up with a deck, and let's say it can't be any more than 5 PowerPoint pages. Okay, you have to get it all in a manageable size. And doing that, putting all the information you need to get out in 5 pages is a problem for most people. They have more than the 5 pages worth of material. So don't turn it into an eye chart. It has to be something I can read. But if you give me something that's 20 pages long, if you gave your bosses something that's 20 pages long, he's not going to read it either. It has to be crisp. It has to be on target, and it has to be 5 pages or less. You need to be able to get your idea out there before you lose everybody's attention. I read one time that people listen for 15 seconds and then they drift off. So, you can't make a pitch that's 9 hours long. It's got to be a brief, to the point pitch. And you're all going to be able to do it. You're going to amaze yourselves. Or maybe you think already you're at peace with both your left brain and your right brain, and this is going to be a piece of cake. So,
Professor,
yeah.
May I ask a question?
Sure.
So do we have to submit a written paper as well, or just the PPT?
Just a PVD. Just,
All right. Okay.
Just the deck. That's your written paper.
Okay. Got it.
It can be words. It can be graphs. It could be numbers. It could be pictures. It could be everything.
All right. So the PPT. Got it. Okay. Thank you, Professor.
Right. No problem. Anybody else?
When is this due?
Oh, I'm glad you asked. Look at it says on the syllabus. I think it was week 7 or week 6. Let me check on the syllabus. It is due week 6. Now, this class stops at May 13th. That's the end of the lectures. Finals are typically a week after, but since we're a 7-week course, class 7 is going to be your last class with the final. Okay, so class 7, if I did this right, looks to me like it's May 13th. And class 4 will have a multiple choice test. And then in class 6, your presentation decks are due to me. And the final is on class 7. So I'll change that on the syllabus. The final's not on class 8. There is no class 8. It's a 7-week course. It'll be on the last class, the 13th. Okay, any other questions?
Professor, can you mention the date of when the presentation is due?
I think it's 6. I think the presentation is due May 6th. Yeah, the presentations are due May 6th.
All right, thank you, Professor.
You have lots of time.
Regarding the quiz for class 4, is that next week or is it the week after that because you canceled class over the break?
It's the next, it's gonna be not this next weekend, not this next week, the week after that.
Okay, so two weeks from now?
Right.
Okay, great, thank you.
People really get into these presentations. You'll be surprised, you're probably done long before the due date. That's the way it worked last time. Anyway, anybody else have any other questions? Okay. I hope you enjoyed this as much as I did. Sorry about the sound quality of the last video. And I'll talk to you next week. Have a good week.
Thank you, Professor.
Professor.
Thank you,
Thank you.
Professor.
Thank you, Professor.